Modern Money Mechanics. A workbook on bank reserves and deposit expansion by Federal Reserve Bank of Chicago. This is an audio summary. Have you ever wondered, what is money really? Is it just the cash in your pocket? Or is there something more mysterious at play? Is money just a tool for buying things? Or is it part of a much bigger game? One with rules that most of us never even knew existed. Today we're diving into one of the most eye-opening documents about how money is really made. Modern Money Mechanics by the Federal Reserve Bank of Chicago. This isn't your average bedtime reading, folks. This booklet pulls back the curtain on the secret world of money creation, revealing how banks can literally conjure money out of thin air every time they issue a loan. Sounds like magic, right? Well, it kind of is. But with spreadsheets instead of wands. You see, most people think of money as something physical, dollar bills and coins. But what if I told you that most of the money circulating in our economy today doesn't exist in any tangible form at all? That's right. According to Modern Money Mechanics, about 90% of money isn't cash at all, but merely numbers in a computer. Created not by the government printing presses, but by banks themselves, through a process called fractional reserve banking. And here's where things get really wild. This system runs entirely on trust. That piece of paper in your wallet or those digits on your banking app screen hold value because we believe they do. But if that belief wavers, well, history has shown us just how quickly things can unravel. Ever heard of the Great Depression or the 2008 financial crisis? Yeah, that's what happens when the illusion cracks. So grab a coffee, hit that subscribe button, and get ready to have your mind blown. Today we're not just talking about dollars and cents. We're exposing the hidden mechanics of money creation, the master magicians behind it, and the dangers lurking in the shadows of our financial system. This is the financial education they definitely didn't teach you in school. Let's uncover the secrets of money creation and see just how deep the rabbit hole goes. Money, as we know it, has no intrinsic value. That crisp taunt, 100 bill in your wallet, it's just paper, ink and cotton, really. Even the digits in your bank account are mere book entries, nothing more than numbers on a screen backed by a promise rather than gold or silver. But if money isn't valuable in itself, why does it work? Why can we trade it for coffee, cars, or even a house? The answer boils down to one word: trust. We trust that others will accept it for goods and services. We trust that it's worth something because, well, everyone else seems to believe it too. But what if I told you that this trust-based system is a bit more complicated? That's where Modern Money Mechanics by the Federal Reserve Bank of Chicago comes in. This isn't just any dusty economics booklet. It's a play-by-play manual on how money is actually created. And here's the twist. Most of the money in our economy isn't created by printing presses at the US Mint. Nope. It's conjured by banks every time they issue a loan. It's like this: when you walk into a bank for a loan, the banker doesn't reach into a vault to hand you stacks of cash. Instead, they simply type a number into your account. Voila, new money is created, digitally. This isn't just any magic trick, it's called fractional reserve banking. It's the financial equivalent of pulling rabbits out of a hat, except instead of rabbits, it's money, and instead of a hat, it's your local bank. Imagine this. You walk into a bank and deposit $1,000 of your hard-earned cash. By law, the bank is only required to keep a fraction of that, let's say 10%, as reserves. So they tuck away $100 for safekeeping. But what about the remaining $900? That's where the magic begins. That $900 doesn't come out of your original deposit. Your account still says $1,000, and you can withdraw it whenever you want. But at the same time, the bank can lend out $900 to someone else, maybe to Joe, who needs a loan for a new food truck. So now, in this bizarre financial reality, there's $1,000 in your account and $900 in Joe's. Congrats! The bank just created money out of thin air. But wait, it gets even crazier. This isn't just a one-time trick, it's the start of a chain reaction that can create much more money. Joe takes his $900 loan and spends it on a top-of-the-line fryer. The restaurant supply store owner then deposits that $900 into her bank account. Now that bank keeps 10%, $90, and can lend out to the next borrower. And the cycle keeps repeating. This process is called the money multiplier effect. According to modern money mechanics, if you keep following this chain, that original $1,000 deposit can eventually expand into $10,000 circulating through the economy. That's right, the banking system can create 10 times the original amount out of thin air just by repeating this trick over and over. But hold on, you might be thinking, isn't that risky? What happens if everyone wants their money back at once? Excellent question. And that's the dirty little secret of fractional reserve banking. It works only as long as most people don't rush to withdraw their money all at the same time. If they did, well, remember those old black and white photos of people lining up outside banks during the Great Depression? Yep, that's a bank run. And here's something that'll really bake your noodle. The money created isn't backed by gold, silver, or even a giant vault filled with cash. It's backed by debt. In fact, as modern money mechanics points out, debt is the very engine of money creation in our modern economy. Every dollar in your pocket represents someone else's debt. So next time you swipe your card or cash a check, just remember, you're part of a financial illusion that only works because we all believe in it. The magic of modern banking isn't just about money, it's about belief. So who's the master magician behind the scenes? The one pulling the strings, deciding how much money flows through the economy, and keeping the whole house of cards from collapsing. That would be the Federal Reserve, the central bank of the United States, often called simply the Fed. This institution is like the head wizard of a financial Hogwarts, armed not with wands and spells, but with powerful tools like open market operations and reserve requirements. Now, these tools might not sound exciting, but trust me, they are the levers that control the very heartbeat of our economy. Here's how the trick works. Imagine the Fed decides to buy $10,000 worth of government bonds. When it does this, it doesn't roll over a Brinks truck full of cash. Instead, it simply creates money, just types it into existence on a computer screen. This new money goes into the bank account of the bond seller, boosting the bank's reserves. And here's where the real magic happens. Thanks to the fractional reserve system, that $10,000 doesn't just sit around. The bank only needs to keep a fraction of it, say 10%, and can lend out the rest. But every magic trick has a counterspell, right? If the Fed decides it's time to rein things in, it does the opposite, selling government bonds. When investors buy these bonds, money flows out of the banks and back to the Fed, shrinking reserves. And since banks can only lend based on the reserves they have, this simple action makes money disappear, like reversing a magic trick. Poof! But it's not just about making money appear and disappear. The Fed has a bigger goal: controlling inflation and keeping the economy stable, or at least trying to. See, if too much money is created too fast, prices skyrocket and inflation spirals out of control. That's when your morning coffee suddenly costs $10. On the flip side, if there's too little money, businesses struggle, unemployment rises, and the economy stalls out. According to modern money mechanics, this delicate balance is why the Fed is always tweaking interest rates, buying or selling bonds, and adjusting reserve requirements. It's a constant juggling act, trying to keep the economy growing without letting it overheat. Imagine a DJ at a club, adjusting the volume so the crowd keeps dancing without blowing the speakers. But here's where it gets really interesting. The Fed's power isn't just in the money it creates, but in the belief that it can keep the show running smoothly. As long as people trust that the Fed can pull the right levers at the right time, the magic continues. But if that trust falters, well, that's when things can get really scary. Bank runs, financial crises, even the collapse of entire economies. In fact, modern money mechanics doesn't just hint at this risk, it flat out warns about it. The booklet explains that the entire system is a kind of high-wire act, balanced on the razor's edge of public confidence. As long as people trust that their money is safe, everything runs smoothly. But lose that trust, even for a moment, and it's game over. This is why the Federal Reserve exists, to act as a kind of financial firefighter, ready to flood the system with cash if a panic starts. And if you're thinking, well, that was then, surely we're safer now, think again. In 2008, the world got a terrifying reminder of just how fragile this system is. Banks stopped trusting each other. Credit froze. The financial system came this close to collapse. And it all came down to one thing: trust. But here's where it gets even darker. According to the booklet, even if the Fed steps in and prints money to stop a panic, it's only a temporary fix. More money means higher inflation, which eats away at your savings and wages. It's like plugging a hole in a sinking ship while water keeps flooding in. The real danger isn't just a bank run. It's what happens after, when confidence is shattered and people start questioning the entire system. So, where does that leave us? Should you stuff cash under your mattress and hope for the best? Maybe not. But one thing's for sure. Understanding how money really works is the first step to making smarter financial choices. Because let's face it, if you don't know how the game is played, how can you ever hope to win? According to the booklet, the real secret is that money is, at its core, debt. Every dollar in your wallet represents a promise, either by a bank or the government, that it can be exchanged for goods or services. And that promise is only as good as the faith we have in the institutions backing it. Lose that faith, and the whole system unravels faster than you can say recession. So what can you do? For starters, arm yourself with knowledge. Understand how banks turn your deposits into loans, how the Fed manipulates money supply, and how inflation slowly chips away at your purchasing power. Knowledge isn't just power, it's financial survival. The good news? By learning how the system works, you can start making decisions that protect you, whether it's diversifying your investments, keeping an emergency fund, or just being more aware of what happens when the Fed announces a new policy. If today's deep dive blew your mind, make sure to smash that like button and subscribe for more eye-opening content. And if you're watching this at night, maybe double-check your bank balance before you go to bed, just saying. Thanks for watching, and as always, keep questioning the world around you.